Hi, Daria. Can you hear me?
Yes, I can hear you.
Now I can hear you. Is it going to be just you and me again today?
Mm-hmm.
Very, very possible, huh? I think we should get started, okay?
Okay.
Now, the last time we met, we went over chapter 5. Is that correct? Adjusting journal entries.
Yes.
Do you want to go over that chapter again, or would you like to go into chapter 6? That gets us a little bit ahead of the class.
I think we can go chapter 6 because I already did chapter 5.
Okay, good to hear. Very nice to hear. So let me see if I can share the screen here with chapter. Here we go. We always got these little glitches to begin. For heaven's sake. Okay, let me open here. Here we go. I think I know what to do here. Hold on. Get rid of that. I have to go here. Okay, chapter 6. We come here. Share. Okay, I think we're gonna get there. Can you see the PowerPoint now?
Yes, I can see.
Thank you. I had a little trouble getting there. Okay, here we go. Some slideshow. Uh-oh, my football team, they got slaughtered again Sunday, but okay, that's beside the point, right? Nobody cares. All right, here we're going to get into the closing process, okay? We had that big, long 10-column worksheet that we're going to go through. And if you remember, Daria, we started off with the trial balance, right? We get the trial balance, we get those numbers directly from the general ledger, whatever the balance is in each account. The trial balance tells us that debits equal credits. And at that point, we learned in chapter 5 that trial balance that we print at first is not adjusted. We have to adjust it for supplies we use, wages that were earned but not paid yet, depreciation expense, etc. So now here, and then after, let me just go back a little bit. We put those adjusting entries in this next pair of columns, and then columns 5 and 6 was the adjusted trial balance. Now here, we're going to go into what's called the closing now, huh? The worksheet, we covered the journal entries in chapter 5. In other words, chapter 5 was pretty much the first 6 columns of the worksheet. Now we're going to use that worksheet to prepare the financial statements, and then we're going to learn about what are called closing entries. You can prepare the financial statements right off the worksheet, okay? We know this already, right? That the income statement must be done first, and then the statement of equity, and then the balance sheet. So with that in mind, the income statement should have a name, title, and it should say period ended. It should say the month of or the year of, and that's kind of important. Or it can just say March 2019 or whatever, okay? Don't worry about the dollar signs on top. Revenues, of course, are shown first, okay? Income statement, revenues, followed by the expenses. This is interesting. It says expenses are listed in account number order or descending order by dollar amount. I've honestly never seen that. I don't think it's important in the order, okay? All right, so here is our worksheet, and this is the worksheet that's complete, okay? This is the worksheet with columns 7 and 8 now. So let me see if they back us up a little bit. Okay, no problem. That's fine. Okay. The first 2 columns, trial balance. Next 2 columns, adjustments. 5 and 6 columns were your final adjusted trial balance. So now we're in columns 7 and 8, the income statement, okay? And I hope you remember, you see that horizontal line above the green 8,000? Why did we put that line there? Do you remember?
You mean income statement?
Yeah, you see that 8,000?
Yeah.
Why is there a line above that separating these two sections of the worksheet? The reason is everything below that line is your income statement. Everything above it is your balance sheet. And basically, to do the financials, you're going to copy every single one of these numbers over except one, and that's going to be the change in the capital. So here's a nice, simple look at an income statement, huh? Nice, simple, single step income statement. Name of the company, income statement. Notice it says month ended. You can say for month ended, you can just say March, whatever month this is, June 2020, you could say. You could say for the, you could say for the end of the month, like it says here. That's kind of important, and you'll see why as we go along. So look what we did, Daria. We just copied all the numbers over, and we put them in a readable form called an income statement. You start with your revenue and a colon, and then most companies have more than one revenue. You know, Coca-Cola, for example, might have revenue, and then the first line might be sales of Coke. Next line might be revenues, Diet Coke. You know, however they want to split them up. So you can see a whole bunch there. And then you subtotal them on the right. This is a very good presentation. Put all the subtotals on the right. All you do is list the expenses, add them up, and this company had a lovely profit of $4,640. Man, I wish I invested in that company, huh? The business was worth $8,000, and they have earned almost 60% on the dollar. Okay, so you feel comfortable with the income statement? I think you are. Is that fair to say? Okay, and we get the numbers just like that. What is the second financial statement we have to do? We do the income statement first. And why do we do the income statement first? You can take a look at the screen. Because we have to now do the statement of equity. We have to take this profit, this 4540, and we have to now do it, put it into the statement of equity. Statement of equity. This is the statement where we're going to compute the new capital balance. We're going to take the beginning capital, add the net income, subtract the drawings, and that's all we have to do. So we're going to start with the beginning. Capital from the worksheet may not be the beginning capital. That's okay. It's the beginning as far as we're concerned for this month. He made no additional investments. So we're going to show revenue. Instead of showing revenue increasing and expenses decreasing, this statement uses the net of, okay. Oh, yeah. Okay. They're making it much harder than it needs to be with those words. Look at this page. This is the key right here, huh? Mitchell at the beginning had 0, but we can consider the 5,000 the beginning too, right? I mean, he had no company. The first thing he did was invest 5,000. So we can call this the beginning if we want, okay? So the beginning was 5,000. We add the net income and we subtract the withdrawals. When we subtract those two, they're showing something called increase in capital. Okay, so our capital increased from 5,000 to 6,640. Any questions on this statement, Daria? You feel pretty good with this? Okay. All right, now we did the income statement first because we needed to get the net income for the statement. Now we can do the balance sheet once we get the new capital number. That's why you do them in that exact order. And we're going to show this thing. Liabilities are shown below, account form, assets on the left. There's all kinds of different ways to present the balance sheet, and we'll look at one here. This is important. Current assets come first. Now here, these are going to be in the order of your chart of accounts. That's a bit easier way to say it, okay? That means your current assets, current liabilities come first, then the long-term items. We know what current assets are, huh? Assets that are going to be consumed within a year: cash, accounts receivable, supplies, insurance. We certainly hope we're going to get our accounts receivable paid within a year. And now they're kind of backing us up a little bit. They're showing us the operating cycle. I'm not sure this is too worth looking at, but let's go through it. It's here. Operating cycle. You have some cash to start the business. You buy supplies. You provide services for cash on account. You collect. Everything goes cash to cash. Ashes to ashes, cash to cash. Property, plant and equipment. Plant, they're called plant assets. We call them fixed assets. Plant assets is a good term, but the fixed assets: land, building, equipment, cars, trucks, all kinds of things. Fixed assets are going to be here for many years, many years, we hope. And we're going to use those assets to build our product, provide our service, and we're going to depreciate it. Current liabilities. Current liabilities. Anything due within 1 year of the normal operating cycle, typically a year, we'll say, and they will be paid with current assets, obviously. Current liabilities, accounts payable, wages payable, they are always current assets, and there could be other current assets. You might have interest payable in 90 days or something. Long-term liabilities. These are the debts that don't come due in the next year. Obligations not expected to be paid within a year. And we can also call them long-term debt, long-term liabilities. Good example is a mortgage. You buy a office building and you put $100,000 down in cash, and the deal is you pay the $900,000 over the next 10, 20, 30 years. That is the long-term portion of this, okay? Mitch does not have any long-term liabilities yet. Now we're ready to go to the balance sheet. We just did the equity statement. Balance sheet, like I just said, current assets first, then the property and equipment, and you get the total assets. Current liabilities, he just has two, but we add those up. And then the capital account never shows the net income, and it never shows the drawing. You are never going to see the net income on the balance sheet, nor are you going to see the drawing. And that is because we took the net income and we moved it into capital. You remember on the statement of equity? We took that net income and we added it to the beginning capital. Now we have to subtract the drawing, which we did with the statement of equity, statement of owner's equity report. And guess what? The balance sheet must balance. The balance sheet is a presentation of your accounting equation, if you want to look at it that way. Assets equal liabilities plus equity. Let me blow this up so at least I can see it. Huh? It's all about me. Okay, here we go. Here's your worksheet. That says balance sheet on top, right? This is column 9 and 10 of our 10-column worksheet. So let's take a look at our balance sheet if we can. See if I can move this over. Here is our balance sheet. Notice it says June 30th. You have to say on a balance sheet something like June 30th or at June 30th or as of June 30th, because the balance sheet, unlike the income statement and the statement of equity, is a photograph. It is a photograph. It is a snapshot. This is one split second in time. As of the end of this date, As soon as the clock struck midnight at the end of the 30th, this is how much money we had. Sorry about that. This is how much money we had in the bank. This is how much money customer owes us, etc. So our balance sheet has to say as of or a specific date, and that's very important. Current assets come first. You would put current assets and put a colon after that, maybe indent a little bit, present it so it makes it a little easier for the reader to follow. So we add our current assets and we have a total of 4220. He had delivery equipment and we depreciated $80. It was depreciating $80 a month for 60 months, I believe. So our net book value of the assets, okay, net fixed assets is 4720. I would rather see that 4720 on a separate line that says net fixed assets, but that's okay. We add the current assets, the long-term assets, 8940. Where did we get every single one of these numbers with the assets? You see, right from here. They're nicely lining up blue and blue. And then we have the accumulated depreciation, which is a contra asset account, as you know. Thus, it has to be subtracted on here. And now we're ready for the liabilities. Well, we only had two liabilities, 1900 and 400. So there we go. Now we just have to put the new capital number in. And what was the capital at the beginning? It was 5,000. We had that net income of, what was it, 4640, I believe, minus the 3. And I'll move this up here. Oh, good. I'm glad they're showing it. Zoom, zoom, zoom. Forgive me, Dari. Just give me a second here. Zoom. Zoom. Okay, that's exactly what I want to say. We did the income statement first so we could do the equity statement. And then when we did the equity statement, we had the new capital balance. And look at that beautiful balance sheet, huh? What do you think so far, Daria?
That's fine. Like, I understand.
Okay. Not all right. Should I try to make it harder? No, just teasing. Okay, here we go. Let's get out of here. So that was the financial statements. Of course, a business owner can put more money into his business. We should know that, huh? And if he does, that's going to go right into capital and it'll be on the trial balance, blah, blah, blah. Okay, hold on. Additional, I don't know why they're emphasizing this. Let me take another look. Additional investments by owner. They're going to go right into your equity account. And they're going to be showed on the statement of owner's equity. Okay, so here we're showing a business where he had a beginning balance of 5,000, different company, Ramon Balboa. During the period, he threw in another 3. The 8,000 balance, of course, is going to be looking something like this. He started off with, I can't say it, started off with 5. We're doing July, right? Beginning, where's the beginning? 5,000. Okay, the beginning here was 5,000. You can read that, right? $5,000. They just told us, right, that he invested 3, invested additional 3. We add that up and we can show that if we want like that, total investment. That's not much of a curveball, right? That's pretty easy, huh? You may have capital at the beginning and you may not even do any business. You may have no sales. You may have nothing, but you threw in some more money into the business to get it going further, okay? I'm going to assume you're okay with that. And now, are you ready for something new? Closing entries. Oh, closing entries. You know now that when we prepare the income statement, we do it in order to update the capital, which means those expenses no longer exist, really. We've gotten rid of them at the end of the month. And that's called the closing process. So let's go through this. I think you'll find it interesting. Permanent accounts, accounts that you never close. Balance sheet. Balance sheet, you never zero the balance sheet out. It goes forever, forever, the entire life of the company. Assets, liabilities, capital. These accounts are not closed. They're never closed. What are closed are what are called the temporary accounts. These accounts are closed to zero every month. Okay, you mind if I move this over here? Since it's just two people. Okay. All right. Whoa, boy, I'm comfortable in my easy chair now. Okay. Temporary accounts. We close them. And here's how we do it. We are going to go and give the temporary accounts means income statement. Temporary account means revenues, expenses, and drawing. We're going to give them a zero balance, and the next month comes along. If you look at rent expense, it'll be zero. If you look at salaries expense, it'll be zero at the beginning of the next month. And we're going to run these entries through an account. Now, here's a new account you're seeing for the first time. Income summary. Income summary. It's used to help out, to aid in the closing process. We're going to put all of these revenues into the income summary. We're going to put all the expenses there. Here are the 4 steps. You ready? Step number 1, close the revenues. Revenues have a credit balance, right? We know that. Revenues have a credit balance. How do we close it? Well, we close it by debiting it. We're going to debit all our revenue accounts so that they reflect zero, and we're going to credit income summary. Income summary at the end of the month is always zero. You will never see income summary on any financial statement or any financial report. It is just a mechanism to close the income statement into equity. So revenues have a credit balance. How do we close them out? We zero them out with a debit. You debit every revenue. You do the same opposite effect with expenses. Expenses have a debit balance. Therefore, we are going to credit each and every expense. If you're working with a company that has 100 expenses, you must credit every single one of them. And then at that point, we will debit income summary. Okay. So let me take this a little bit further. When we closed the income to the income summary, we've put the income there, and then we put the expenses there. So the balance now, and I'm going to ask you this question, what does the balance now in the income summary equal? We put the sales in we put all the revenues in, and then we put all of the expenses into the income summary. So what does that balance represent?
So,
what are revenues less expenses? What does that equal?
revenue will be credit in summary account, income summary.
Yeah, my question is this, you had income, say, of $100, and now you credited the income summary for that, right? Because you debited. And then you had expenses of 40. 100 minus 40 would be your what?
$60 credit.
Your net income.
Income summary.
Yeah, your income summary would have now the net income. And okay, this is a little tricky. We'll keep going here. Net income is there. So what did we do? Wrong. Come on. We did steps number 1 and 2. We put the net income into income summary. That's what I was trying to say. We put the net income now into income summary. That net income equals the income summary account. Step 3, now we're going to debit, in this case, we're going to debit the income summary, which now has the net income for the month, and we're going to credit owner's capital. A little confused by that? At this point, that's okay. That's okay. And you'll see it in a few more slides a little more clearly. We have gotten rid of the revenues and we got rid of the expenses and we put them into the account called income summary. And then we're just going to use that to move it over to capital, okay? Drawing gets closed directly to owner's capital, but let's not worry about that just yet, okay? So here is what we're talking about. Here are the revenues. They have a credit balance, right, Daria, over here? We closed those revenues, those sales are closed with a debit. And what do we credit? We credit income summary. We debit revenues and credit income summary. The expenses we credit to zero them out, and we debit income summary. So the balance in the income summary is now our net income. And let's say the net income was $1,000. Now we have to move the income summary to capital. So now we're going to zero out the income that's here. We only put it there temporarily. The income summary is like what we call a clearing account. Now we're going to zero out the income summary, and now we credit income. We have moved the net income into capital. And we'll go over this a little more. It's a little tricky. You see it for the first time. We have to close drawing as well. We close drawing, but we don't use the income summary because it has nothing to do with the income statement. Drawing has a debit balance. It's a contra capital account. So we credit it to get rid of it. Credit, and the debit goes to owner's capital. So if you think about it this way, we have owner's capital with a beginning balance of some kind. We know on our equity statement, we increased capital with the net income, and we know we decreased capital for the drawing. So we've reflected everything here. So let's take it a little further. Income summary, net income. We're just going to look at a net income. I don't want to show a net loss. We're optimistic, right? So here's what we have. We had here revenues of $5,000. Okay. And we debited those revenues and we credited the income summary. We had expenses of $4,000, which we credited and debited to income summary. So at that point, income summary balance before closing is $1,000. And then we're going to move that 1,000 up to capital and get rid of the income summary. So let's continue. I think this is a real good look at what we're trying to do here. Okay. Let's look at it with some numbers, huh? Let's make it a little more user-friendly here. Okay, Daria, let's see what we have here. We had revenues of 8,000. They're telling us that. This is from the same numbers we saw before on that income statement we did. Revenues, fees, sale, 8,000. We have to zero it out. That means we have to debit delivery fees, and we must credit income summary, okay? We have to do the same thing with each and every expense. Wages expense, 2,050. Rent expense, 1,000, etc. We credited this to get rid of that debit balance. We credit. And when they're all added up, we move them up to the income summary. So the credit side of the income summary is your revenues. Debit side would be your expenses. So there is $4,640 profit. We moved into the income summary, which we are now going to zero out into capital. So the closing process represents the job of zeroing out everything on the balance sheet, which would be your profit or your loss, and moving it into capital through this clearing account called income summary. Talk to me, Daria. What do you think so far?
Now it's clearly like it's better to understand with this.
Starting to understand it now a little bit?
Mhm.
Yeah, it's a little bit tricky. Yeah, a little tricky. Now let's continue here. Here you go. This might help us too, huh? The journal entries. Journal entries. Look at your journal entries here. How did we clear out delivery fees? With a debit, we credit income summary. So the balance of income summary now represents your sales. How do we get rid of all these expenses? By crediting them to zero, adding them up, and that becomes a debit to income summary. So the balance in the income summary now is 8,000 minus the 3,360, which represents your profit. Now we can update equity or capital by crediting it and getting rid of the income summary. So the income summary is kind of a middleman, if you will. Okay, it's just there to help us at the end of the month. And what did we say about drawing? Drawing is closed directly to capital. Drawing has nothing to do with income or the income summary or the income statement. So you close drawing with a credit and you reduce your equity with that debit. This journal entry, this is what you should be looking at maybe when you're doing your homework. And you do these a few times. It's not too tough. Students tend to make this harder than it really is. If you understand why we're doing these closing entries, we are doing them to get the capital updated to its proper number. That's basically what the closing process is. Okay, so at this point, we have no more revenues on the general ledger. We have no more expenses on the general ledger, and thus no more profit on the general ledger. So there's one last thing we will do. One last thing we will do, and that is prepare what's called a post-closing trial balance, huh? It's prepared after we close. And again, the only thing the trial balance does is tell us debits equal credits. But here's the new kicker. You will only have the permanent accounts there. Didn't we just zero out all of the temporary accounts? Yeah, there's no more sales. There's no more expenses. So your post-closing trial balance is going to be assets, liabilities, and just that one new capital number. Do you understand why there's no expenses or revenues on this trial balance now? We zeroed them out, right? You look a little confused.
Um, no, I just thinking like,
Okay, I talk fast. I'm from New Jersey. I told you all about New Jersey, right?
yeah.
The stupidest state in the union. No, there's absolutely no doubt about that, believe me. Okay. We zeroed everything out with these journal entries. Remember these journal entries? Delivery fees are now zero. They're gone. All these expenses are gone. They don't exist anymore. They're gone. So the only thing left are the permanent accounts. And what are the permanent accounts? Balance sheet. Balance sheet is permanent. Income statement stuff, close it every month. Make a little bit of sense? Starting to. Oh boy, I don't know if we want to look at the steps in the accounting cycle. I'm afraid to go to the next slide. Let's see what they're talking about. Okay. Let's look at it. You know when you know a slide is no good, Daria? When it's got this much stuff on it.
Yeah,
Slide,
it's
you know
confused,
what I
like
mean?
we don't have picture like to see like, examples, like only text.
Yes. Yes, you don't want to see this much information. But what
Mhm.
you're doing here is briefly summarizing, okay? During the accounting period, step one, you're analyzing source documents, paper, an invoice from a vendor, a cash payment, a check in the mail, a bill from the utility company, an email or a text from your boss telling you to do something. You know, you can print these things out, and those are source documents. You record all your transactions, post them to the ledger, and we're done with the month. Okay, so this is pretty much chapters 1 through 4 right there. Now we prepare our trial balance. This is the 10-column worksheet now, I guess, huh? First column, we put of course, we put the accounts names down. We prepare a trial balance, make sure it adds up. We adjust it as needed. We record our insurance expense, our supplies expense, wages, etc. We then go to columns 5 and 6, and that's going to be the end of the period worksheet. Okay, we go to the end of the worksheet. We do our adjusting entries. And then when we get to the new trial balance, we do the financial statements, which is what we just went over. And now we do the closing entries and the trial balance. This is not hard. It's just, if I was sitting in the classroom for an hour and all of a sudden this popped up, I'd go, oh, geez, it's too much. Okay. Not too much, though. Not that hard. Statement of cash flows. We are not going there. We are not going there. When you get to accounting 230, you will be taking accounting 230, right? You hesitate. When you get to accounting 230, you're going to do a ton of cash flow work. Yeah. So I can safely say that the statement of cash flows is not going to be on any tests. Okay. And also, Dari, I'm saying this to you and to the others who might look at this video later. I go through the test. I don't prepare the test. Cornelia is doing that. And her tests are a combination of her questions and things at random, perhaps, from the McGraw-Hill, or in this case, the Cengage test bank. What I'm saying is, after the test, I go through every question. And if I see something that I didn't teach and deliberately didn't teach, I add those points back, okay? So you don't get stiffed. All right, you want to go into chapter 7, 8, 9, 10 now, or are we good for chapter 6? I think that was enough, right? Any questions?
Not yet. Like maybe I think I'll have questions like after, maybe like tomorrow, because I should think about all these chapters.
Right. All right. It's a little overwhelming right now, huh? Yeah. When you come back on Thursday, I think we come back Thursday, I believe. That's when you probably have some questions.
Yes.
Because on Thursday, I'm going to go through this again with the rest of the class. Okay. I may not record that meeting because I think this was a pretty good presentation, just the two of us here. Okay. So come on back on Thursday with your questions, And it'll probably just be me and you anyway. So we go into chapter 7. We've got like we got like 30 something people in this class. Where the heck are they, right?
Mhm.
Okay, well that'll be it then, huh?
Yeah.
You know, Das Vidania and you know, all that stuff, right? Mishki Zimno. That's Polish, right? Mishki Zimno. What does that mean in Russian? Mishki Zimno.
I don't know, what is it?
In,
Mishki?
in Polish, it means cold. It's very cold.
Oh, in Russia it's different.
How do you say it's cold or very cold in Russian?
Холодно.
Okay, see, I can't even pronounce that. Yeah, I'll go to my grave very annoyed I never learned to speak my daddy's language, huh? All right, well, you take care, Daria. Off you go,
Okay,
and we'll see you later.
bye.
Bye-bye.